Hey guys, Boris, welcome to our commodity dollars review for June 20th to 24th, 2016. Hopefully these pairs are going to be a lot less volatile than the majors this week, of course, because it's Brexit week. So we probably may have, for those of you who want to trade a more calmer, quieter trade, these could be the looks for you guys to take a gander at. There's also not as much news on the commodity dollars this week, but they will be very much affected, and for a lot of different reasons. So I wouldn't necessarily say they're going to be extraordinarily calm, but they will just be calmer on a relative basis, I think, than the majors as we go this week. Let's take a look at the charts here and just see how things set up first in the Aussie in the other commodity dollars. So let's start with the Aussie first. So Aussie had a big rebound. We had data last week that was kind of mixed as far as the unemployment data goes. We have RBA minutes which were sort of mixed, and we don't really have that much on our plate this week as far as Australian data goes. But what we did see off of just the technicals last week is that the 73s clearly seems to be a pretty decent support for the time being now. Now, the chart itself is in the process of developing, so it's one of those kind of things where it's either glass half full, glass half empty type of a structure. Because if you look at it from a buy point of view, you definitely have a higher low, a pretty decent buy up from the 73 level, and a potential here to go to 75. And I think probably on a more immediate basis, the bulls have an edge here technically, and probably fundamentally, just because the market this is really sort of the story that's unfolding in front of our eyes is what I call the Brexit relief story. That Brexit is not happening, risk stays calm, equity markets recover. All of that is relatively positive for Aussie, in conjunction, by the way, and this is the other interesting thing, in conjunction with the fact that even though everything starts to calm, the Fed is unlikely to move on rates. So the spread, the carry trade, still favors Aussie. And to me, and one of the interesting things I think that could happen here is if we get no Brexit and a relatively similar statement from Janet Yellen this week, because we have those two big events coming up, then Aussie is one of bigger beneficiaries, because it gets the beneficiary from the fact that global flows are going to calm down, and the assumption that the Fed still stays stationary for a while. So this is the only game in town as far as yield goes, and we could easily move through the 75s, maybe even take out the 75s here on a closing base. Although that is a very, very decent resist point. It's a triple, quadruple resist point, so it's going to take quite a lot of work to take out 75s with conviction. If we do take out 75s and close above 75s, it really puts a much more positive spin on the trade and makes it a buy the dip type of a structure for quite a while. Conversely, if you look at this as a sort of a glass half empty trade, what you see so far is a series of lower highs, and even more importantly, even on a micro basis, a series of failed highs here because we took out the 75s and we haven't been able to take them out. So you could take a short here on the assumption that it's just not going to reach 75s, at which point technically it will begin to start to break down, and we could be targeting 72s as a potential level of support. But that is, it's a minor, I guess it's a minority point of view, but it's one of those kind of things where the minority may win. It's definitely a legitimate point of view from a technical perspective. The more conventional, common view when you're looking at the chart here is to just get long and strong here and hold the 73 support as sort of 7250 as your key support here underneath here as the first level. 72 is the ultimate level of support to break down, and then targeting 75 and a break above 75 higher. It's a toss-up, which is exactly what the market of the week looks like. So hard to say how you'd want to position yourself. The charts giving you really perspective from both ways, but at least to me, for the first half of the week, if you sort of assume that the market gets more, if the polls come in and if the polls come in and the vote on Brexit is even, that means Brexit is not going to win, because the general assumption, you always have to assume that agent of change is much harder to achieve than status quo. So in order for the leave vote to really have a decent chance of winning, it has to be up by 5 to 7 percentage points, at which point they could squeak by. That's how you have to really read these things, because in history that's always been the case. People always say they're going to do one thing, but then they stay with status quo. So if you're 50-50 into the Brexit, it probably means it's not going to happen. It probably means that this trade is more of a buy than it is a sell. And so technically, I still favor the long side here for the time being. But be wary, because everything, as I said, can change on a dime this week based upon whatever's happening out of UK. Kiwi, on the other hand, looks less attractive. We have, a failure here at the 75. We really haven't been able to kind of buy up through this level. Hasn't had nearly as much of momentum carry. Ironically enough, I can't quite put my pulse on it. The market has sort of, I guess, bought up the Kiwi post the RBNC decision, and then after that, whatever buying we've had has just been far more muted. Kiwi for now still looks to be less positive than Aussie, and in fact, it could be one of our looks. We're going to take a look at the crosses and some of the cross potentials, and it's still. It could be an interesting take a look at the cross the other way. We were looking at the cross to the short side. Now it may be actually potentially a bottoming out cross potential. But for now, Kiwi is the laggard, and unless we take out the 7150, at which point that would really put it into a much more positive structure, it looks to be like kind of a failure with the support at 6950, 6900 as the near-term support for Kiwi. This is probably going to be the least volatile trade of all. So if you sort of want to hide out, make a bet on the on Brexit and kind of hide out with least amount of risk, this probably could be the trade for you. So if you think Brexit fails, you could probably buy this up and it'll still give us a run all the way up to 7150 with a 6950 support level. If you think it succeeds, then the drop here certainly could take us all the way out to 6850 as we go forward. Caddy, which is our last look on the commodity dollars, was very interesting. I don't know if I don't remember if you remember me mentioning this a couple of weeks ago, but we had a failure of fundamentals, which is one of my favorite trades. So last week I think we had Canadian employment data. It came in bullish, and yet dollar CAD rose, which is a negative trade for Canadian dollar. It means that the market shrugged off the positive data. From that point onward, as I said last week, it was a screaming buy, and it actually went up, I think, a couple of hundred points, maybe about almost 300 points before it finally kind of flamed out at the 130 level. So this is interesting to me because, dollar CAD, of course, 130, you can really see it on the charts here. This whole 130, 132 level, clearly big resist level in dollar CAD. And it's a question really how far the market wants to sell the Canadian dollar at this point. But it still looks to me, of all the trades here, as the strongest pro-dollar trade, meaning that the Canadian dollar is the weakest against the dollar. Even the fact that we flamed out above the 130 brought in a lot of sellers here and took the Canadian dollar right below. Because once we flamed out, there wasn't really as much of a follow-through as I thought there would be. We're still effectively, I think we might have to, this is one of the few charts where I might really have to go on an hourly basis just to kind of analyze the situation. We flamed out above the 130.50, found sort of a support at 28.50, and I think honestly, as long as the Canadian dollar, this is the level of support that I'd be looking at. As long as we kind of hold 28s, it's a buy, not a sell. This was a big move off of the 130s. I would actually be a buyer here rather than a seller, because the Canadian dollar is not responding nearly as well to the anti-dollar flows as all the other pairs. And certainly this 127 seems to be a very decent support to the bottom. So one of the more interesting things technically that could happen is, and this would be very, very bullish for Canadian dollar, bullish for dollar CAD and bearish for Canadian dollar, is suppose we have a situation where we recover all of this flame out. In other words, the Canadian dollar climbs all the way up to 30.50 and higher. If we do that, it's not an engulfing candle, but it is a very, very powerful technical signal saying that the buyers clearly really want to take it higher. And the potential here could be a breakout above this 132 level all the way out to the 135s. So to me, I think the risks reward here still favor the buyers, especially at these levels, with probably like a 28 stop, maybe 27.50 stop if you want to give yourself a little bit of a out, with a potential to move higher on the fact that Canadian dollar just simply is failing against the dollar much more than all the other currency pairs. So that's kind of how the crosses shape up. Let's just take a look at the levels and see where everything stands. So Aussie, we moved up the support level a little bit because it's nowhere near the stress points that it was last week with 72 now, the big support level, 75 still the big resistance level. With dollar CAD on a longer term basis, yes, this 125 is sort of the big support, but I think the more intelligent support is the 128 near term. The resistance to 130.50, I guess, if you were going to mark it to the charts, but really, honestly, it's probably going to be 131 at this point. So if we can take out, and we're going to run all the way up to 131, that could be a very bullish move for dollar CAD, but that's probably where it's going to find a little bit of resistance as we go forward. And then Kiwi really maintaining most of its levels because it had the least amount of volatility this week with the 71.50. The one thing that I think is interesting is that if Kiwi manages to take out the 71.50, that really would turn it into an incredibly bullish move, and we could see maybe 73 before the trade kind of runs out of steam. To the downside, it seems to be the safest place to hide. If you get a risk aversion flow, I don't think you're going to see much more than 68.50 on Kiwi as a downward move. So that's how the commodity dollars shape up. The most interesting story out of them, I think, is the fact that the dollar still performing really, really well against the CAD, and it still looks to me as the best trade as it did last week on a dollar long basis. So wish you guys the best of luck, the best of trading. Boris, over and out.